Hey listeners, today we had on Armani Ferrante, the founder and CEO of Backpack, which is a wallet and crypto exchange. Interestingly, Armani and some of the Backpack team came from FTX in Alameda, the exchange slash research shop that blew up in 2022. We get into that a little bit in this episode, but more so, Armani's just a really thoughtful guy on the state of crypto in general. And we get into perpetual futures, why he thinks crypto wallets are getting it wrong, some of the founder lessons he's learned along the way, and much more. We'll get into it right after this. Hello and welcome back to another episode of Lightspeed. I'm Jack Kubanek, hosting alongside Mert and we're joined today by Armani, the founder and CEO of Backpack. Also, I believe the first ever Lightspeed guest back in July of 2023. So Armani, welcome back. Good to have you.
Yeah, thanks for having me, guys.
So Backpack is a crypto wallet, also an exchange. You know, for more of an overview of just their story and what they do, you can go check out the previous episode. But where I want to begin this conversation is with perps. So perpetual futures, they're a kind of DeFi derivative that lets users speculate on the future price of a crypto token without an expiration date. And a couple recent moves from Backpack have been geared in this direction, including the launch of interest-bearing perpetual futures, I think. Adding to this, there's also Hyperliquid, which is a new kind of perpetuals exchange that has been one of the more hyped, kind of crypto launches in recent times. So with all that on the table, Armani, I just want to get your take on who wins the perps market in the long run.
Oh, starting with the easy questions. Yeah, I mean, I think there's a couple different ways to look at this. I think we are approaching this very differently than Hyperliquid, in the sense that Hyperliquid is, trying to be a decentralized exchange or an L1, and Backpack is a centralized exchange, and we really lean into the centralization component. And one of the common misunderstandings of exchanges more broadly is that the decentralization or I should say the centralization of exchanges is not like predominantly an engineering question, although that tends to be the lens through which most people view it. I view decentralization as more or less like the optimal architectural decision from an engineering point of view. And so what's kind of interesting about the Backpack exchange, and honestly, I would assume centralized exchanges in the limit, is that they take a lot of the core design principles of L1s or kind of decentralized architecture, but that does not mean that they're not compliant. And so I think the decentralization is like maybe the wrong framing for the conversation. I think it's more about compliance versus censorship resistance. And I think that is like the more correct framing. So yeah, I mean, Backpack, I mean, you mentioned Hyperliquid, I suppose, just because they've done such an incredible job with their go-to-market, and there's really, they really kind of showed just how incredible of a community that they've built is. But I think it applies more generally. It's not just specific. There's nothing like specific to them other than they just did a terrific job. But for context, if you look at you go check out the GitHub and you go look at Backpack or whatever, like what does the exchange look like? And what you'll see a global linear log of authenticated transactions. You'll see multiple different versions of the matching engine, all replaying the exact same transactions, all signed with an ED25519 signature by some client that has some key pair somewhere in the world. And you'll see a deterministic state machine replaying the transactions, and you'll see 2 of 3 parties doing threshold signatures to apply all deposits and withdrawals to and from the system from any chain, from Solana, from Bitcoin, from Ethereum, so on and so forth. Is that a blockchain? Is that an L2? Is that an L1? It's like, I don't know, like that's just like a smart way to build an exchange, right? And so what's kind of interesting about the centralized exchange versus decentralized exchange conversation is that it's really easy to miss that they all kind of look one and the same. If you're really building it, like in my view, kind of the way you should be building an exchange, there's really no technical difference purely from like a just like an architectural point of view. And really, the difference is like, are you so geographically distributed all around the world that it's impossible to censor this thing? And as a result, like the kind of, last century of rules and regulation and the whole compliance regime that runs the world just legitimately doesn't make sense. Like, I don't know how you would force anybody on Solana to like, make any of the decentralized exchanges adhere or come into compliance, because like it literally just, it's an undefined problem. And that is a very different thing than, say, I'm here in Tokyo, literally every single centralized exchange hosts their matching engine 30 minutes away from the building I'm in right now. And everybody's kind of in the same data center in AWS or whatever, where it's very easy for a single kind of, authority, that, Japanese government or whatever can go walk down into that, to that data center and just shut everybody off. Right. And so kind of the rules and regulations and laws of whatever country that you're serving users in is like, it makes much more sense. There's a point of control. You literally control the funds, whether it's a multi-sig or just the physical machines or whatnot. And so the way I think about exchanges is really kind of through this lens. It's like, okay, we could talk about this at the engineering level, and like what the optimal architecture is for building these systems. But then we can also kind of talk about this from the censorship level. And like the question is really simple. It's like, are you censorship resistant or are you not? And if you are censorship resistant, then you fall squarely in the land of decentralized exchanges that we all know and love, everything kind of running on Solana. And then if you're not censorship resistant, you are not censorship resistant. You should be not censorship resistant by design. And that's because you're compliant. You follow the laws and the rules and the regulations of whatever country that you're serving people in. And this is kind of the predicament that all centralized exchanges find themselves in today. And nowhere is this more apparent than, I guess, in two places most recently. So in Europe in particular. So what you've seen in Europe is basically the world's largest perpetual futures exchanges all get shut down or move out of the EU. So Binance has no futures or derivatives in Europe. Bybit, no derivatives in Europe. OKX, no derivatives in Europe. These are like the best products. Like these exchanges really build the best derivatives products, but they've all been more or less pushed out of the EU because they ran into kind of compliance issues or whatever. They didn't have the right licensing or whatever idiosyncrasies in their path dependent paths or whatever. And here in Japan, similar story, right? Where just literally last week, you see like Bybit, BitGet, a whole host of other apps literally removed from the app stores. And so this is like a very kind of real issue that is that all the exchanges are really coming to grips with right now, and all kind of, namely the international exchanges. The Coinbases of the world have kind of been ahead of this, but the international exchanges are all kind of realizing that these things matter. And so this is kind of like one of the really kind of motivating reasons why I look at it through this lens.
So it seems, and correct me if I'm wrong, that you've chosen, well, you're a centralized exchange, so you need to choose essentially the compliant version of this. And perhaps what people refer to when they make this dichotomy is, using your example of Europe, if it's a purely decentralized exchange on chain, then what can the European government really do except perhaps ban the front end or something along these lines? It gets pretty blurry in that case. So do you think decentralized exchanges can ever actually work in kind of that dichotomy where there's some central point of control that the government will not allow you to go past beyond?
I think decentralized exchanges absolutely work. It just depends on the context. So I think where they really shine is in spot. I think Pump.Fun in particular just like really showed like, it was the first time where we really saw something blatantly obvious that decentralized exchanges do so much better than centralized exchanges, which is like this long tail of like user generated assets and like instantly list markets for like the 1,000 or 10,000 meme coins that get generated every day. I think where things get blurry is, not to sound too spicy, but I'm on a podcast with Mert, so let's get spicy. Where things get blurry is when people start using multi-sigs for everything, right? And so I think the project that opened up Pandora's box was Base, right? So Base is, nobody serious thinks Base is actually decentralized, right? It's a multi-sig, it's a centralized exchange for all intents and purposes. It's deterministic state machine replication with an EVM state transition function. That's all it is. And then there's a multi-sig controlling all the funds. And so if you go to Coinbase and you say, pretty please freeze all the users' assets, they can do it. And this is like the box that's been opened, and that people are looking at this and asking themselves, oh, I guess it's okay for me to do this. And so you're seeing this really the new meta. I tweeted this the other day. No, people didn't really get it, but the meta is literally multi-sigs right now. And there's this story of progressive decentralization. I don't want to be super negative on Base because I genuinely think they will decentralize it. I think the whole Ethereum community is on this very genuine progressive path of discovering how to build L2s well. And so I think, Coinbase has just shown time and again that they execute when given, they're good faith actors that execute well, I think. And so I don't want to be dismissive or sound too negative there. But I do think you are seeing this more and more and more again. And people are forgetting, there's a reason why things are decentralized, right? There's a reason why things are censorship resistant. And there's a reason why there's, a century full of rules and regulations for the non-decentralized actors. And there's trade-offs all over the place. And we really have to be honest with ourselves in terms of what we're building, why we're building it, what are the trade-offs involved, who are my users, and what are the use cases. And so to loop back all the way to your question, Mert, I wholeheartedly believe decentralized exchanges are super important. And I think on Spot, it's super obvious, namely Spot for the long tail of user assets. Where this conversation starts getting really subtle, and it's a bit of a rabbit hole, admittedly, is when you start talking about margin systems. And I'm happy to unpack this, but there's one kind of property that you have to acknowledge about a margin system. With a margin system, you don't own your assets. There's no concept of self-custody if you're trading perps, if you're trading spot margin, if you're using borrow lending, there's no self-custody. The system controls your assets. The liquidator controls your assets. If the price moves against you really fast, it has to have the ability to unilaterally take you out. And so the question is ultimately who's doing the risk modeling, who's running the liquidator, and what's that system look like? And I think that is the awkward point in decentralized exchanges right now that I think there hasn't been a lot of conversation around, which is how do you decentralize that component? And I think that's really important. But in any case, you're following the rules of the system. So yeah, that's how I'd maybe start that conversation.
This episode is brought to you by Bonk Bets, the fully permissionless sportsbook built on Solana. Bet with Bonk, Solana, or USDC and get automatic payouts for winners. Every bet that you take earns Bonk Bets points towards cashback, discounts on losses, and more. Lightspeed listeners get 10% back on losses to bet again. Just visit bonkbets.io/Lightspeed or click the link in the show notes. Just a quick disclaimer that exclusions apply and Bonk Bets is not available in all jurisdictions. Thanks to Bonk Bets for making today's episode possible.
Could I just ask, Armani, for you to expand a little bit on that decentralization and censorship resistance point? Because I think something I've been thinking about recently is decentralization has always been a big part of the crypto pitch, but I don't know if it's always true that most users have a demonstrated preference for decentralization. They probably just want cheap, fast transactions. They want to be able to trade meme coins. And I don't know if they necessarily are super worried about decentralization or centralized intermediaries holding on to their funds or this kind of thing. So how do you reconcile those ideals with just the mass of crypto users maybe not thinking or necessarily caring much, or maybe they do care, but I don't know. Just go a little deeper there.
Yeah, no, I wholeheartedly agree. So I am not by any means a decentralization maximalist. I am like a user maximalist. I want to solve problem for users and make their lives better. That's it. And the question is not like, okay, like, or the way I would frame it is people do not care about decentralization. I genuinely think people don't care. What they care about is what decentralization gives you. And there's a lot of things that decentralization gives you. So I think maybe the most interesting example of this that strikes close to home for me is just NFTs, where, okay, where did NFTs come from? Why do we all care about these? I mean, maybe not the entire world, but certainly people in crypto care. Like, why are we spending $15,000 for a Mad Lad? And why couldn't we have done this before decentralized censorship-resistant blockchains existed? NFTs seem to be a unique like element, like discovered by the world from blockchains. And if you put an NFT on a less decentralized chain, it's a lot less valuable than if you put it on a more decentralized chain. And it's like, well, okay, why is that? And I think, you can talk about provenance. You can talk about, trust minimization. You can talk about, the history of the asset or whatever. But one of like the first things that decentralization gives you is the ability for everybody to collectively like look at something, and I can believe in one God, you can believe in another God, I can believe in communism, you can believe in capitalism, but we can still all come together and agree on the ledger, right? So it's really all about kind of for me, kind of global capital formation. It's like this singular database that no matter who you are, where you're from, what your background is, what your view of the world, we can all agree to that, like this strings of ones and zeros means what I think it means. And I can be China or I can be the US government, and it doesn't matter. We can all kind of agree to trust the thing because it's decentralized and censorship resistant. And so I think that's the thing that people care about. It's not like decentralization because I want like some Nakamoto coefficient to go up because it like looks cool or whatever. It's because, I want NFTs. It's like, I want instant settlement for stablecoin payments. Like, well, why do you get instant settlement? Oh, it's because you can't manipulate the ledger. It's like, because it's correct by construction. It's, I signed something, therefore I authorized it. And so I think, I don't think people care about decentralization. They care about the product, right? And so you have to make great products, and it's kind of as simple as that.
I want to go back to the margin point because I think it was sort of unfinished. But if I'm to reiterate, it seems to be something like decentralized exchanges are very important, especially for spot, where you have self-custody, right? The user owns their assets and whatnot. However, when you start getting into the realm of perps and margin-based systems, such as lending, the system technically owns the products, but the system, if it's a multi-sig, then even if it says it's decentralized, perhaps it's not so decentralized. And so at that point, the lines are super blurry, and basically it's a centralized exchange. Can you say a bit more about why is that the case? Is this because margin systems are very risky in that if there's a bug in them, then it doesn't really make sense for it to be decentralized because now you've just wiped out a whole ton of leverage in the system? What is, do you think, the historical context of the current construction, but also probably more importantly, what do you think is the right way going forward? What's the ideal architecture?
So I think there's a couple things. So firstly, maybe to lay some context. So the difference between spot and a margin exchange is simple. When I'm trading on, I'm saying like swapping on Jupiter or Orca or whatever, I have my funds sitting in my wallet. It's on my ledger. I sign a transaction. I want to swap SOL to USDC or buy meme coin or whatever. It's a single atomic state transition that goes from my wallet to swap with some asset that then sends the other asset back to my wallet. So there's no like risk outside of that state transition, basically. And you can even build that in such a way that you like guarantee that you get the right quantity. You can assert that slippage is within some error tolerance of your choosing. And so your risk is really it's like self-evident by the singular atomic transaction that you swap in. When there's no like custody risk of any sort. The custody risk is, I suppose, yourself. When you enter the world into like margin trading, so like you're trading perps on chain, it's a very different model, right? So instead of trading from your ledger, you have to move assets from your ledger into a separate system, right? Into a separate smart contract or into a centralized exchange or whatever. And so you now have tokens that are sitting inside of a bucket, basically, that is separate from your ledger. And in order for kind of for you to trade on margin, if you say open up a perp position, say like go long or short on SOL, I'm using the tokens in that bucket as collateral. And if my position goes up or down, because maybe I long and the price of SOL goes down and I start taking on losses, the system needs to see that my portfolio value is going down in dollar terms and that I'm getting more and more leveraged and that my equity is going to zero. And I need to be able to sell that SOL into dollars so that I can close down the position. And it should be clear that if I'm levered, if I'm like 10x long or whatever, I can't just be like, oh, I have my ledger, I'm not going to sign this transaction, I'm not going to let you liquidate me, right? That's you're when you go into a margin system, you're basically signing up for the rules of a game, basically, where the rules basically say, I can liquidate you if the price moves or whatever. And it's more or less my view, I suppose, after having built one of these things, that the scary thing about margin exchanges is not custody. It's really risk management. And this is true if you're the CME, it's true if you're Binance, it's true if you're Backpack, it's true if you're Drift. It's really a question, like the scary thing to me, the thing that I think about constantly is like not how to manage custody, which, okay, I think plenty about custody and I think we have a great custody system. But the thing that I think about constantly, because it's a continuous thing, is just risk management, which is, the question is, there's many questions that you have to unpack here. Now, when you're talking about decentralization in the system, it's no longer simply about, well, who's executing the state transition. That's, on spot, it's really simple, right? Just like, you have 1,000 validators all around the world. They're geographically distributed. That's more or less censorship resistant, or pick your number or your threshold, because you just care about a single state transition. When you're thinking about a margin system, you're thinking about the state of the system, like when your funds are at rest, but when prices are moving. And so you have to think about things like, oh, well, who is controlling the upgrade authority for the program that is controlling those funds? Well, if it's a multi-sig, then it's basically a centralized exchange. I mean, you can say whatever you want, but it's a centralized exchange in the same way that, Base is a centralized exchange. And there's plenty in that camp. Okay, that's one thing. That's probably the lowest hanging fruit if you want to do to point out kind of things. The second thing that's maybe a bit more subtle as well, who is running the liquidator? Who is running that piece of software that is monitoring prices, monitoring portfolio values, and saying, oh, Mert's becoming too leveraged. I need to send a transaction on chain to go and liquidate Mert, because otherwise he's going to get bankrupt and we're not, and he's not going to be able to cover the loss. So somebody has to run that infrastructure. It's like, okay, well, now you need a censorship resistant liquidator. And if the liquidator is not censorship resistant, then the exchange is not censorship resistant. Therefore, it's not a decentralized exchange. And this was really the first problem that, if you want to go way back into the old days of Solana, of Serum, right? Which is like, you have a crink, you have this off-chain mechanism that has to push the state transition function. And there was companies that spun up like clockwork that tried to like solve this problem. Eventually Ellipsis came around and built a crankless order book. And so there's definitely some iteration here in terms of like design, in terms of how to build kind of these systems, right? Whether you're decentralizing the off-chain crank component, in this case liquidator, or you're building the system in a crankless way. I think it's probably fair to say that you can't build a liquidator in a crankless way. You always need somebody to look at the latest price update, and you always need somebody to look at the health of an account and then to send a transaction to liquidate. So that basically can't be done in a crankless fashion. So that's the next question to ask is like, okay, who's running the liquidator? Answer that question. How many liquidators are there? Why is it censorship resistant? Is it as censorship resistant as Solana? Is it as censorship resistant as an L2? Does it not matter? But that's a point of control. And that's a really fucking important point of control. Excuse my French, but it's a really important point of control because whoever's running that liquidator determines whether the system is solvent. Okay, and so that's a super important question. And so that's the next maybe second question. Then there's a third category of things that's even more subtle. That's equally as important as having the upgrade authority, and it's equally as important as monitoring or operating the liquidator, which is to say who's doing the risk modeling, and who's managing that, who's verifying it's correct, what are the assumptions being baked into it. Basically, every single margin system has some concept of a price impact function, and it has some concept of like how volatile a given asset is, and the way to think about this is simple. If I'm using my SOL as collateral to say long Bitcoin on some DEX or whatever, and I have like a Bitcoin position, and I have a SOL using that as collateral. Well, when I liquidate those positions, two things happen. The first thing that happens is I sell my Bitcoin position onto a Bitcoin perp market. So I sell in the opposite direction. But when you sell something, the price isn't constant. And so if you sell 1 Bitcoin, it's different than if you sell 10 Bitcoin, and it's different if you sell 100 Bitcoin. And so it should be clear that it's the price as the size goes to infinity, the price, like the cost of or the cost of like liquidating that position becomes larger and larger and larger. And so you need to basically define some concept of how do you model like the price impact and what is the cost of liquidating this position. And that requires a human to sit down and make a judgment call, to make some assumptions, to pull out their, Jupyter notebook, to make some pretty graphs, to run some, do some analysis. But that is like a really important question. And if you get that curve wrong, you go bankrupt. And you get that curve wrong, that's how you have a margin blow up. Right. That's how you have, you could, there's different plenty of examples of this. I mean, throughout finance, whether it's in crypto or whether it's in centralized finance or TradFi or whatever. But that is a huge point of failure in these systems, and you have to get that right. I think one of the great parts about kind of putting that on chain, though, is that you can kind of have a very bright light on that. And so I think that's actually one of the really kind of amazing benefits is just like decentralized risk analysis just seems to be like quite compelling to me. But I don't know if in practice people are doing that because there's, I guess, maybe not that many people in the world that actually know how to like make that decision. But that's like the next question. It's like, who's doing the risk modeling? What are the parameters and how do you kind of define that? So I think these are all of like the various like topics to like you have to unpack, and whenever you're analyzing a DEX, you have to ask these questions and walk through it. It's not as simple as like, oh, it's on Solana, therefore it's a DEX. You know what I mean? And so it's a very nuanced conversation.
This episode is brought to you by Bonk Bets, the fully permissionless sportsbook built on Solana. Bet with Bonk, Solana, or USDC and get automatic payouts for winners. Every bet that you take earns Bonk Bets points towards cashback, discounts on losses, and more. Lightspeed listeners get 10% back on losses to bet again. Just visit bonkbets.io/Lightspeed or click the link in the show notes. Just a quick disclaimer that exclusions apply, and Bonk Bets is not available in all jurisdictions. Thanks to Bonk Bets for making today's episode possible.
Yeah, it is. And it's nice to have you on the pod to walk through some of that stuff because I think there's depth that get communicated on Twitter or wherever these conversations happen. That's the exchange side of it. I want to ask you a little bit about the wallet side of things, because it's something I've been thinking about recently. Phantom, the popular wallet, just raised $150 million Series C, I believe, at a $3 billion valuation. And I don't know, I've been thinking along with that just about the business model of wallets, because Phantom, I believe, charges a fee when you swap with them, but otherwise it's just sending and receiving crypto. It seems to me like it could be a candidate to be commoditized, those fees driven to zero, because it's very replicable. So, as someone who's been building a wallet for a couple of years now, how do you think about the business model for wallets? Are they a loss leader that drives people to your exchange, or is there an actual path forward to justify, a unicorn valuation for a crypto wallet?
So, I mean, I think Phantom has done an incredible job. There's no doubt about that, including their just enormous contribution to just the industry as a whole. With that said, I think fundamentally all wallets are broken. And I think if you just look at the numbers, it tells you everything. So a quick story, I was opening up the Soulflare wallet the other day. And I set up a new wallet. I wanted to check out the app. It had been a while. And when they ask you to save your seed phrase, they give you a pretty jaw-dropping statistic. It's like pretty incredible. What they tell you is that $4.2 billion is lost every year to people that lose access to their wallets. It's roughly what they tell you, $4.2 billion. So this is more than every centralized exchange every single year. If that's not a complete and total spectacular failure, I don't know what is. Like, that is just absolutely egregious. It's like embarrassing. If that's like the state of the industry, then like we failed as an industry. It's my belief that this is a completely solvable problem, and that self-custody is really what makes the industry special. Without self-custody, it's like, I think you can question a lot of everything that's happening here. Although I still think there's a lot of compelling applications of a lot of this stuff, but I digress. And so the question is, like, how do you solve this problem? And I think there's a couple different attack vectors. Firstly are like rugs. It's like, okay, rugs are a thing. Phishing attacks are a thing. I'll kind of like hand wave that away, although I think there are solutions to that. The thing that I think needs to be changed right now is just the concept of like, what is a wallet? And like, what does it mean to like own my assets? And how do I actually build a product that I can send to my parents and say, hey, here you go. Here's a backpack app. Go put in Sol into it. You'll be fine. I think it's fair to say we're not there yet. I don't know about you. Just question. Would you guys, are you guys comfortable giving your parents crypto? Like, yes or no?
No, not currently.
No. I asked this to everybody. Nobody is. And so I think one of the really exciting things that we're working on right now, it's really in like an private alpha experimental phase. I hinted at this to you, Mert. I told you that there'd be no BS, there'd be no gimmicks, and I'll prove to you that having a centralized exchange will be the safest way to custody your crypto. And so let me unpack this to you. It sounds ridiculous, right? I'm fully aware of how ridiculous this sounds. So my pitch is that account abstraction, if you want to use that term, is the future of all wallets. That all EOAs are fundamentally broken, and that if you're building an L1 right now, do not use EOAs. Throw out all concept of EOAs. This like maybe the biggest advantage, one of the biggest advantages any new L1 has. Just like, don't come in with the technical debt of EOAs. Just throw them away. Everything's a smart contract. And what you can do is, instead of having your assets being owned directly by the ledger, you have your assets controlled in, let's say, a squad's multisig, and your ledger controls the squad's multisig. And so when you change your orientation this way, you can build these really magnificent constructions that just completely solve the recovery problem without losing self-custody. So let me give you an example of a construction. So one of the products that we've been iterating on just in private in the company has been this kind of new kind of account abstracted wallet where the UX is very, very simple. I sign in with my exchange account, email, password, 2FA, no problem. I'm in. It's just like using Coinbase or whatever. But then when I go to my portfolio, I have this wallet that I can use. And it has my NFTs, it has my tokens, I could stake Sol, I could connect to dApps, I could swap on Jupiter. But when I go to do any action that moves money, not only does it ask me for maybe my exchange 2FA if we want, but also it'll ask me for my ledger, my hot wallet, my passkey, pick your favorite wallet, of choice, and that's like a 3FA of sorts. And so your wallet really becomes a 3FA. And so you have this really great user experience where it's just a centralized exchange, but your wallet, for all intents and purposes, is a 3FA. And it's like, okay, what does this look like under the hood, and why am I not getting rugged? And so I'll maybe get slightly technical, maybe not too technical. What you can do is you can build a 2 of 4 squads multi-sig. Squads of E4, totally vanilla. You can see it on chain. It's immutable, formally verified, built by the Chads over at the squads team, where you can have 2 tiers of members on the multi-sig. The first tier are instant signers. So one instant signer is my wallet. So let's just say my ledger, just for simplicity. And then the second tier is the exchange infrastructure. So let's just say it's like an exchange, just some EC2 instance or whatever. Pick your favorite AWS infrastructure. There's some private key being hosted somewhere on some cloud infrastructure. And in order for you to get the signature from the cloud infrastructure, you need to be logged into your exchange. You need to have some Web2 auth, a JWT, a session, an API key of sorts. You just need to be able to access the Web2 API. You have Web2 auth. And so as long as you're signed into the exchange, you have these 2 instant signers. So I'm logged into the exchange. I go to swap an asset, or I go to connect to a dApp. The exchange instantly signs it transparently because I'm already logged into the exchange. And I get this nice 3FA that's just like my ledger. And I'm just like, all right, boom. I sign with my ledger and I sign. So that's 2 of 4 of the multi-sig. And I have an instant signer through squads. Now there's this question of, okay, well, what happens when you lose the wallet? How do you recover it? So there's the second tier of signers, which are time locked. And so you can think of it simply as like a 7-day and a 14-day time lock. You can make the numbers whatever you want. So let's call it 7 and 14 days. The 7-day time lock is you. So it's it's a second, not multi-sig of sorts, where it's controlled by your ledger. So unilaterally, you can always sign with 2 members of the multi-sig. You always sign with yourself, which is instant, and you always sign with your second member of the multi-sig, which is just your ledger, but with a time lock. It's really simple. And so if, say, Backpack tries to screw you, no problem. You just log into the Squads UI, you pull out your laptop, you get a terminal, you spin up a Solana validator, and you just send a transaction with your ledger. Boom, you have your assets. You get them back in 7 days. However, if you lose your, obviously I'm an exchange founder. I don't think that'll ever happen. That's like a preposterous scenario, but like, FTX, and we've all seen kind of the disasters of the past. So you don't want to assume that. The much more likely case though, is not that the exchange screws you, it's that you screw yourself. And this is just base reality, right? If you look at the numbers, this is the much more probable scenario. And so if you lose your key pair, say you throw your ledger into the ocean, God forbid, your house burns on fire, as had happened to a lot of folks recently in California. These things are very real scenarios. But if that happens, no problem. Log into your exchange account. Maybe call customer support, talk to our compliance team, and recover your wallet in the exact same way that you would recover your bank account or your centralized exchange account. And at a technical level, the way it works is that the exchange has an instant signer, and the exchange has the 14-day time lock. Really, all that matters is that the exchange's time lock is longer than the user's time lock. That is how you maintain the self-custody. But long story short, you just go to customer support, you verify your identity. Unironically, this is where the compliance actually helps a bunch. I don't know about you, but I feel a lot safer when somebody can actually verify who I am and it's not like somebody trying to scam me. I have to show them a government document or whatever. I understand that's a contentious point, and different people have different feelings, and you can apply this construct to a non-KYC system. But I think for a lot of people, the KYC actually provides a lot of solace, especially if it's your life savings or whatever. And no problem. You lose your keys, and we recover it. You swap out your ledger that you threw into the ocean with a new key pair, and you're off to the races. And so if an FTX collapse happens, no problem. You have your assets. If you throw in your ledger into the ocean, no problem. You have your assets. And there's really only one case where you lose your assets. In this case, is really it's like kind of a law. It's not like a law of physics, but it's like a fundamental thing that you cannot get around if you want self-custody, which is to say that if somebody steals your ledger and you have no other copy anywhere in the world, if those two things happen to you, somebody stole some adversary steals it and they're trying to screw you, and you have no copy, then you're toast. Because at that point, they're the owner and they have the self-custody and they can unilaterally take your funds. So that's a long-winded breakdown of the construct, but I think this maybe provides some kind of insight, I guess, into how I think about it. I genuinely think account abstraction is the future, and it's because you can build stuff like this that really doesn't exist anywhere else.
Cool. So it seems, yeah, that's a good construction. I would use it. And it seems roughly 2 attack vectors, though obviously quite unlikely. One is just, somebody literally just becomes you by becoming your private keys, which in this case, it seems like with the exchange, you could actually make them verify some other things. So you're safer than doing pure custody. Or the nuclear scenario, which you lost everything and the exchange says, well, I have the time lock here and your other thing, and I'm not going to do it. But then if you're centralized, that becomes a legal problem. So that seems like a good construction overall. One thing I'm curious about myself is, so you're doing a lot of work here. You started with the wallet as the first release along with Mad Lads. And I do want to get to Mad Lads in a few minutes. I think the go-to-market was around X NFTs at the time, and then you started adding an exchange component to this. That's a lot of work, and you've also moved to Japan, a lot of stuff going on here. Why are you doing this? What is the mission?
Why am I doing this? So I think, there's a couple things. So, we started with X NFTs, we started with the wallet. Ultimately the question to start was, what is like the thing that, that we felt that the industry needed. At X NFTs, I think what a lot of people were thinking about decentralized app stores at the time. Unironically, or ironically, I guess, Saga was like being built at the exact same time, and we were thinking about similar things or whatever. It was really the collapse of FTX that caused the pivot, where the company was, for all intents and purposes, dead. We lost all of our funding. We tried to go out and raise. We couldn't raise. The only kind of ability for us to raise was to completely do just ridiculous extreme things. And so we really had to reimagine ourselves and think, how do we actually fight to survive? Cut all costs, and think about what reevaluate what the market looks like. What are the business opportunities, and what are the problems that we need to solve? And the exchange really, I'm not a crazy person. I don't wake up one day and be like, oh, I want to build an exchange or whatever. I know just how hard building exchanges are. The real big unlock for the exchange for me was really, one of my partners, Can. So Can he was the GC of FTX. He has a very kind of storied history as a lawyer. There's nobody on the planet that is as hard of a worker, as kind of a person, and as knowledgeable as a person. And when it comes to all things, when it comes to international compliance and crypto law, but it's really the compliance piece that was the unlock. Without that, there's no exchange. And it kind of goes back to the beginning of this conversation, where it's ultimately my view that all products and companies in the space, particularly anything that's really working in finance, is going to fall into one of two camps. Either you'll be totally decentralized and really the best of what the industry has to offer, censorship resistant, no single point of control, fully verifiable, or you'll be fully centralized and fully compliant. And you see this with all decentralized exchanges. They're all running into their own various versions of issues, having to build up big compliance teams right now and really bolt on this stuff after the fact, which is really challenging to do. And you see them getting kicked out of various countries, having to shut down products and so on and so forth. And so the compliance piece was really the thing where I think a lot of people saw the FTX hole that was created in the market. And a lot of people tried to, raise money and try to capture it, but they didn't really know what that hole looked like. And one of the big kind of pieces was just really kind of building out that global compliance element, where no matter where you are in the world, if you're in Tokyo, if you're in Dubai, if you're in Europe, if you're in the USA, there's all of these idiosyncrasies that are required to, follow the law or whatever. And I think what's really special about an exchange, it's like, nobody cares about compliance. They care about what compliance gives you, right? Like the product, right? Why do I care about all this stuff? And what it all adds up to is the exchange sits in the center of two economies. On the one hand, you have the crypto economy, what we all kind of know and love and spend our entire lives, honestly, being obsessed with. And that's really the future. But I think one of the very real kind of just realizations that I think a lot of people in the industry have had over the past year is this kind of admission that, like, what are we all doing here? Is this stuff actually valuable? Right? Are we just all building a casino? And like, what's this like Ouroboros, like snake eating its own tail thing, right? You see Vitalik, lamenting about DeFi, right? It's like, this was like months ago or whatever, it was a while ago, but it's like, okay, people build a token that, incentivizes you some protocol, which then like emits some other token that then you put back into the original protocol. And it's like the circular thing that's not actually valuable. It's just like, okay, it's cool tech. This is like cool, like ledger technology. It's verifiable, state transitions. It's like, censorship resistant. That's awesome. But what is it? What are we actually doing? Like you have to be rooted in like humans, right? You have to be rooted in like value and like goods and services. Like intrinsic value is an actual thing, believe it or not. And I think this is a really important question, right? And I think, one of the best examples of a company solving this is just Circle or Tether, right? Where, with Circle in particular, you see a company that they don't call themselves a centralized exchange, but for all intents and purposes, they're a centralized exchange, right? They accept deposits and withdrawals for any chain. They do a bunch of compliance stuff. They tokenize an asset and they trade one asset for another asset, right? Fiat for USDC on Solana or USDC on Solana for USDC on ETH or whatever, right? It's an exchange for all intents and purposes. But what they do is they sit between these two worlds, right? Where they sit between the crypto economy and the traditional economy, where they can manage fiat and bank accounts, and they can go to, take that fiat and convert it into U.S. treasuries, get a bunch of yield, and redirect that to stable coins on chain. And so they're really this wonderful bridge between the traditional economy and the on-chain economy. And this is ultimately, in my view, why centralized exchanges are so important. And this is why compliance is so important, is because what you're really doing is you're building like trading systems or whatever, but what you're really doing is you're connecting these two economies, especially tapping into all that value in traditional finance, which is where all of the value is, just to be like, to state the obvious. Like, the value in the world is not in crypto. The value of the world is in TradFi, right? We have to be pretty naive to think otherwise. It's our dream and our ambition and our vision to bring all that value on chain, because we think, these trust minimized ledger systems are genuinely actual upgrades for, the back end of the financial system, whatever your, metaphor you want to call it. But being able to plug into TradFi is so important. And it's such a bad idea to pretend like these things don't exist, which is really what you see most decentralized projects doing, right? They're like, oh, screw centralized exchanges or whatever. I'm a decentralized exchange. Like if you do KYC, you're like a loser, you're a bad person or whatever. It's like, no, like I just want to follow the law so that I can actually help and actually improve this like deprecated, old, archaic, kind of opaque, brittle, plagued with collapse after collapse after collapse financial system that runs the entire world. And this is really the thing that the unique position that compliant exchanges find themselves in. And it's only when you solve all those really hard problems can you then bring all of that on chain, and start talking about this dream of like, bringing U.S. capital markets or internet capital markets on chain, right? That's not happening without this compliance piece. And the wallet is really the bottom of the funnel. It's the end state, right? Where, you're using stuff on chain. It's all about self-custody. It's all about, DeFi. It's all about, this flourishing and ever growing on-chain economy that allows us to, do all the things that, we care about in the industry. It's really the thing that inspires us. And so, being able to go through that entire user journey from the beginning to end, I think is a really powerful position. And that's ultimately, I think, where Backpack stands.
A piece you touched on there, Armani, and throughout this is FTX, the issues when things blow up in crypto. And yeah, a big part of Backpack's story is just the team's connection a little bit to FTX and Alameda. You coming from there as well. There's this piece that you wanted to just build a better exchange because you saw FTX collapse and wanted to do so safely. There's also, we've reported about your FTX EU acquisition, which we're not going to get into on this pod because there's some unsettled things there, but you can go to Blockworks to get the details on that. One question I'm curious about, and I don't know if you're able to answer it, but a big part of the Backpack FTX story is that you raised, I believe, 20 million, including from FTX Ventures, and those funds were caught up in the FTX collapse and ultimately vanished. But you are a creditor now, I believe. So have you been able to actually claw back some of the venture funding during the estate payout process?
Yeah, great question. So basically what happened was, our funds were stuck on the exchange. The company was kind of more or less dead. It wasn't until after our last fundraise, so we kind of resuscitated ourselves and got back up and running, and then we sold the claim. So we sold our claim basically. This was kind of after our last fundraise, but before we knew just how valuable the claims were. The decision for us was really simple. It's like, as a company, we need the money now this year. Otherwise, we have no company. And so we didn't have the luxury of waiting however long it was. Even now, like only the claims that are being processed are like the small claims, right? Anything, I forgot what the exact threshold was. I think it was like on the order of tens of thousands or something. Ours was obviously much larger. We had 14.5 million. So who knows when those larger claims, who knows if ours would have been disputed, given, we are kind of, I don't know what the details are there. I'm not going to speculate or whatever. So it was, there's tons of uncertainty there, but we decided to sell it.
That's fascinating. Do you, I think it was a bit of a surprise that the payouts ended up being as big as they were. Obviously, you would prefer not to have payouts at all, but I think it was something like 118% of your holdings is what people are getting paid out. And if you had known that, would you have sold for, I'm guessing, pennies on the dollar, or do you still think it was the right move to do that?
Yeah, to be clear, it was the notional value. I think a lot of people are still really upset because they don't want dollars. They want their Bitcoin, which is worth a lot more. Sol. A lot of us had Sol. that was a big haircut. But I think the question is ultimately when do those larger payouts come out, right? If it comes out in a year from now, no, I want the money now. I think as a startup, you like, time is everything. You don't want to have infinite runway. And like, well, I mean, I guess you do want infinite runway, but you don't want to like stretch your runway out so that I'm alive like 2-3 years from now and not have a business 2-3 years from now. I want to know this year, or should I do something else? And so that was kind of the calculus. Obviously, at the time, we had no idea it was going to be, how high as it is right now. We thought it was like going to be a lot less or whatever. But yeah, that's kind of how I thought about it.
Cool. I do have 3 questions, but we have no time. So I'm going to ask that you practice some brevity as much as you can. The first question is, so you obviously have Mad Lads, and I still see quite a few people holding them, and there seems to be still a lot of activity there. So what's kind of the vision with Mad Lads right now?
Yeah. So I think the way I think about NFTs is that they're not tokens. They're not utility vehicles. In the most genuine sense, they are just art. And then the question becomes, well, how do you build art? And to me, art is ultimately about cultural relevance. It's about distribution. And there's one metric I care about with Mad Lads. It's eyeballs on the images or on the logo per second, and just maximize that KPI over a long period of time. And that's how you build art. And I can talk about this forever, but it's really distribution, a game. So that's my practice at brevity.
Cool. Well, the other 2 questions are related in that they're about startups, and you're obviously building a startup, but you are vocal about your opinions on it, which is nice to see. Don't see too much of that in crypto. What is the biggest mistake founders make, and what is your biggest tip for future founders?
The biggest mistake that crypto founders make specifically is thinking that crypto is like some special thing. And all of the wisdom of traditional startups applies to crypto as it applies to any other startup. Your job, there's plenty of people that will make a lot of money doing a lot of really silly and dumb things. You should not copy those people. And ultimately, as a founder, your job is to solve problems for the world or to build things that the world wants, and the world rewards you for it. It's so simple. It's what everybody in YC or San Francisco will tell you. It's not to build a community. It's not to build a token. It's not to build an NFT. Those things are all great. They supercharge everything that you do. They give you purpose. But fundamentally, you have to think of yourself as a problem solver to earn those things. And so like a community is like the best example of this. Like I think of communities as like tribes. Communities aren't like friend groups. That's the thing. It's like a tribe. I depend on a community for survival. I depend on a tribe for survival. And so like I might hate people in my tribe, but I still work with them in my tribe because collectively we all are better off together than we are alone. And it's about like that economic incentive. And so you have to earn your tribe, and you have to create like opportunity for your tribe and create the ability for your tribe to survive and to be better off, and to contribute to something that is greater than the sum of its parts. Whether that's an L1 network, where it's all the validators and builders and startup community coming together, whether it's a decentralized exchange and you have like this two-sided marketplace of like market makers and takers and people trying to bootstrap a liquidity network effect, whether it's, decentralized physical networks or whatever it might be. Right. And so I think that's like the biggest misconception in crypto, and where a lot of founders, I think, have been led astray.
And the biggest tip?
Yeah, I think it's probably a boring tip, but yeah, just work on, I think there's a lot of value in just working on obvious, boring problems over a long period of time. The simplest kind of example of this is just like fiat. Like fiat is just like such a simple product problem, right? But it turns out it's really hard to get like fiat in any country all around the world, and get on and off ramps to
whether you're in Europe using SEPA, or you're in the US doing ACH, or you're in Brazil and PIX, or you're at some random, I don't know, 7-Eleven in Hong Kong or whatever. I think fiat's a good example of that, but I think there's a ton of untapped value in crypto by just grinding through problems that might not be sexy, but grinding through them for a really long period of time. And I think there's not that many people that have kind of have gone that path.
Right. Yeah. That's Paul Graham's thing about the sexy filter, where you want to turn that off, because it turns out that most problems are quite multifaceted and keep going deeper. All right. Well, Jack, that's all I got, unless you have any final questions.
No, I think that that covers it as well. And it's a good piece to end on. Just, turning off the sexiness filter and solving problems. Armani, it's good to have you back on the show. Really appreciate you coming on. And we'll have to have you on once again down the line.
Cool. Thanks so much, guys.
Yeah, best of luck. Take care.